Rising interest rates in the US and other advanced economies can have significant effects on emerging markets, especially those that rely on external borrowing and have low export growth. In this section, we will explore how these effects can unfold and what are the risks and opportunities for emerging economies. One of the main channels through which higher interest rates in advanced economies affect emerging markets is capital flows. When US interest rates increase, investors who have invested in emerging markets to take advantage of higher rates of return may find investment in the US more attractive, prompting them to move capital to the US. This can cause capital outflows and currency depreciation in emerging markets, which can make it harder for them to service their external debt and finance their current account deficits. However, not all capital outflows are equally harmful. The impact of higher US interest rates on emerging markets depends on the reason for the rise in interest rates. If the rise is driven by favorable growth prospects in the US, this can have relatively benign effects on emerging markets, since the benefits of higher US GDP through increased import demand from its trading partners and increased investor confidence should mute the costs of higher rates. In this case, emerging markets may experience stronger portfolio inflows and lower spreads on their dollar-denominated debt. On the other hand, if the rise in interest rates is driven by worries about inflation or a hawkish turn in Fed policy, which we jointly describe as monetary news, this can be more disruptive for emerging markets. In this case, emerging markets may face higher borrowing costs, lower exchange rates, and reduced capital inflows. This can create financial stress and instability in some countries, especially those with high external debt and low export growth. Another channel through which higher interest rates in advanced economies affect emerging markets is trade. A stronger US dollar can hurt emerging markets that export commodities or manufactured goods that are priced in dollars, since it reduces their competitiveness and profitability. This can lower their export revenues and growth prospects. However, a stronger US dollar can also benefit some emerging markets that import commodities or intermediate goods that are priced in dollars, since it lowers their production costs and inflation pressures. This can improve their macroeconomic stability and policy space. The net effect of higher interest rates in advanced economies on emerging markets depends on several factors, such as the size and composition of their external debt, the structure and diversification of their exports, the flexibility of their exchange rates, the credibility of their monetary policies, and the resilience of their financial sectors. Emerging markets that have lower macroeconomic vulnerabilities tend to be more insulated from external shocks and more able to take advantage of new opportunities. In summary, rising interest rates in the US and other advanced economies can have mixed effects on emerging markets, depending on the reason for the rise in interest rates and the domestic conditions in each country. Emerging markets need to monitor these developments closely and adjust their policies accordingly to mitigate the risks and seize the opportunities. How higher interest rates could slow down the global economic recovery from the pandemic, especially if they are driven by more hawkish central bank actions rather than good news about jobs or vaccines. Interest rates are the price of money. They affect how much it costs to borrow and save. When interest rates are low, borrowing is cheap and saving is less rewarding. This encourages people and businesses to spend more and invest in new projects. When interest rates are high, borrowing is expensive and saving is more attractive. This discourages spending and investment and reduces the amount of money in circulation. Interest rates are also one of the main tools that central banks use to control inflation. Inflation is the general increase in the prices of goods and services over time. It erodes the purchasing power of money and makes it harder for people to afford their basic needs. Central banks try to keep inflation low and stable by adjusting interest rates according to the economic conditions. When inflation is high or rising faster than expected, central banks may raise interest rates to cool down the economy and bring inflation back to their target level. This is called a hawkish monetary policy stance. When inflation is low or falling below their target level, central banks may lower interest rates to stimulate the economy and boost inflation. This is called a dovish monetary policy stance. The global economy is facing a challenging situation right now. On one hand, it is recovering from the devastating impact of the COVID-19 pandemic, which caused widespread lockdowns, job losses, business closures, and human suffering. On the other hand, it is facing record-high inflation, driven by supply chain disruptions, energy shortages, rising commodity prices, and pent-up consumer demand. Different countries have responded differently to this dilemma. Some have raised interest rates to fight inflation, while others have kept them low to support growth. The U.S. Federal Reserve, for example, has hiked interest rates 4 times since June 2022, taking them from near zero to 4.5 to 4.75%. The Bank of England has also increased interest rates 10 times since February 2022, reaching 4% in February. These are the fastest and highest rate hikes since the 1980s and 2008 respectively. Other countries have been more cautious or reluctant to raise interest rates, fearing that it could derail their fragile recovery or worsen their debt problems. The European Central Bank, for instance, has only raised interest rates once in July 2022, by 0.25 percentage points, after keeping them at zero for 11 years. The Bank of Japan has maintained its negative interest rate policy since 2016, despite facing persistent deflation. The divergence in monetary policy across the world has significant implications for the global economic outlook. Higher interest rates in some countries could slow down their growth and dampen their demand for imports from other countries. This could hurt the exporters and producers in those countries that rely on foreign markets for their income and employment. Higher interest rates could also trigger capital outflows from emerging markets and developing countries that offer lower returns or higher risks. This could weaken their currencies, increase their borrowing costs, and exacerbate their financial vulnerabilities. On the contrary, lower interest rates in some countries could boost their growth and increase their demand for imports from other countries. This could benefit the exporters and producers in those countries that supply goods and services to them. Lower interest rates could also attract capital inflows from advanced economies that offer higher returns or lower risks. This could strengthen their currencies, lower their borrowing costs, and improve their financial stability. However, lower interest rates could also fuel inflationary pressures in some countries that already face high or rising inflation. This could erode their competitiveness, reduce their real incomes, and worsen their social problems. Therefore, the optimal level of interest rates for each country depends on its specific circumstances and trade-offs. There is no one-size-fits-all solution for the global economy. What matters is that central banks communicate clearly and coordinate effectively with each other and with other policymakers to achieve a balanced and sustainable recovery for all. How higher interest rates could affect different sectors of the global economy, such as commodities, technology, housing, and trade. Interest rates are one of the most important factors that influence the global economy. They affect how much it costs to borrow money, how much people save and spend, and how profitable businesses are. In this section, we will explore how higher interest rates could affect different sectors of the global economy, such as commodities, technology, housing, and trade. Commodities are raw materials that are traded on global markets, such as oil, gold, copper, and wheat. Higher interest rates could have both positive and negative effects on commodity prices. On one hand, higher interest rates could increase the demand for commodities as a hedge against inflation and currency depreciation. On the other hand, higher interest rates could reduce the demand for commodities as they make borrowing more expensive and slow down economic growth. The net effect of higher interest rates on commodity prices would depend on the balance between these two forces. Technology is one of the most dynamic and innovative sectors of the global economy. Higher interest rates could have mixed effects on technology companies. On one hand, higher interest rates could increase the cost of capital for technology companies, which rely heavily on debt financing to fund their research and development. On the other hand, Higher interest rates could boost the demand for technology products and services as consumers and businesses seek to improve their productivity and efficiency in a more challenging economic environment. The net effect of higher interest rates on technology companies would depend on their ability to pass on the increased costs to their customers and maintain their competitive edge. Housing is one of the most important and sensitive sectors of the global economy. Higher interest rates could have negative effects on housing markets around the world. Higher interest rates could increase the cost of mortgages for home buyers, which could reduce the demand for housing and lower house prices. Higher interest rates could also increase the risk of default for existing homeowners, who may struggle to repay their loans or refinance them at higher rates. Higher interest rates could also discourage new construction and investment in housing, which could reduce the supply of housing and worsen the affordability crisis. Trade is one of the most interconnected and interdependent sectors of the global economy. Higher interest rates could have complex effects on trade flows between countries. Higher interest rates could affect trade through two main channels: exchange rates and income effects. Exchange rates are the prices of one currency in terms of another. Higher interest rates could strengthen the currency of a country that raises its interest rates relative to other countries that keep their interest rates low or unchanged. This could make its exports more expensive and less competitive in foreign markets, while making its imports cheaper and more attractive to domestic consumers. This could reduce its trade surplus or increase its trade deficit. Income effects are the changes in income levels due to changes in economic activity. Higher interest rates could reduce the income of a country that raises its interest rates by slowing down its economic growth and reducing its consumption and investment. This could reduce its demand for imports from other countries, while increasing its supply of exports to other countries. This could increase its trade surplus or reduce its trade deficit. As we can see, higher interest rates could have diverse and sometimes contradictory effects on different sectors of the global economy. The overall impact of higher interest rates on the global economy would depend on the magnitude, timing, and coordination of the rate hikes by different central banks around the world.